Hi, Ma'am Jarly. This is our report for BOM 201, International Business and Trade, and we will discuss the module number 18, which is risk management.
What is risk management? A risk management is the identification, evaluation, and prioritization of risk followed by coordinated and economical application of resources to minimize, monitor, and control the probability or impact of unfortunate events or to maximize the realization of opportunities. In simple words, it is the process of identifying and analyzing threats to an organization's capital and earning. And we have three major risks that needed to be addressed. First is physical risk. Physical risks include dangers that pose a threat to physical assets, including your building, equipment, and people. Example is like emergency management plans, facilities at work, fatigue, high risk work, hazardous manual tasks, and etc. Second, we have credit risk. So, credit risk is the practice of mitigating losses by understanding the adequacy of a bank's capital and can loan loss reserves at any given time. It is also a process that has long been a challenge for financial institutions. Why credit risk management is important? It is important to function within any business or company because it helps enable the business to maximize sales while carefully managing its risk exposure. And lastly, we have cargo marine insurance. It is one of the oldest principles of cargo insurance and still has a relevance today. All risk marine insurance is cargo insurance that covers any and all instances of like theft, loss, or damage to cargo. The insurance policy is all encompassing and covers the following instances of theft, loss, or damage of a cargo. Stranding, sinking, burning, collision of a ship, explosion, water damage, heavy weather, shipwreck, theft, and etc. All of these are covered by cargo insurance.
To insure or not insure. So, an exporter can choose not to insure the goods against loss or damage in transit and simply carry the risk. So, there are some problems with this. So, the first is the terms of sale agreed between seller and buyer may impose a requirement on the seller to arrange for cargo insurance. So, in this problem, the seller must contrive enough insurance and prove with documentations. So this insurance is needed for your customers to do not hesitate to buy your products. The second is, in the event of loss or damage, it may be that action is possible against the carriers in charge of the goods at that time. One of the advantages of a cargo insurance policy is that the exporters does not have to carry out actions against liable carriers. So there are some cases of this problem, like when you're ordering on Shopee, then your products has some damages, then the delivery man wouldn't take action for that because it is not his or her fault. It is the seller who will take responsibility of that. So, how do exporters arrange for insurance cover against the physical risk of loss or damage to the goods in transit? The first is the specific voyage policy. It is perfectly feasible for an exporter with an international consignment for shipment to approach an insurance company, invariably through an insurance broker, and request that an insurance policy be drawn up for that particular consignment. A voyage policy is marine insurance coverage for risk to a ship's cargo during a specific voyage. Unlike most insurance policies, it is not time-based but expires when the ship arrives at its destination. So this policy are commonly used by exporters who need marine shipping only occasionally or for relatively small amounts of cargo. For open policy, it is the most common situation that exporters use a broker to approach insurance companies and agree the raising of a policy which is drawn up to cover many shipments and not just one. So for this type of policy, it is less common than it is used to be, particularly because the exporter is often required the payment of an average premium in advance. So under the open policy, individual successive shipments are periodically reported or declared to the insurer and automatically covered on or after the inception date. So this policy can provide efficiency and savings for all the parties concerned, especially when the insured conducts a significant volume of high similar transactions.
Principle of insurance. Insurable interests identify a point in the journey where the risk of the loss or damage to the good transfer from the seller to the buyer. The principle of insurable interest is a vital one to all forms of insurance, which means that the person will suffer a loss should that the property or individual will be harmed. For the exchange risks, in the event that the exporter is invoicing in all foreign currency, it is possible that the pound sterling funds eventually received anticipated because of fluctuation in the relevant exchange rate, which means that the losses that international and financial transactions may incur due to the currency fluctuation. Foreign currency risks can also affect investors who trade in international markets and businesses engaged in the import-export of products and services to the multiple countries. For the claims payable abroad, the insurers will accept a claim either at the overseas destination, usually through to the nearest Lloyd or company agent, or where the policy was issued. All they require is that the claim is properly documented, and as the original documents can only be in one place, there is no possibility of dual claim, which means a provision which may be expressed in a policy and certificate at the request of the assured, which permit the collection of claims abroad from an authorized person whose name is stated in the policy and certificate. For indemnity, most insurance is based on the fact that the insurers promise to indemnify the insured, that is, they promise to put them back into the situation they were in before the loss. Which mean indemnity means security or protection against financial liability. It is a form of a contractual agreement made between parties in which one party agree to the pay for losses or damages suffered by other party.
Next is the Burmese fide or the utmost good faith. The insurers are almost totally dependent on the insured to disclose any relevant information regarding the insured risk. Thus, a person taking out of life insurance policy who failed to disclose a serious medical problem would find that the policy could be voided by the insurers. There is an important application of a Burmese fide to the type of open declaration policies commonly used for cargo insurance. Subrogation. In the event that loss or damage occurs due to an insured risk, then a claim will be made on the insurance company. However, if nothing else happens, we have a carrier who may well be liable for the loss of damage who has apparently avoided any liability. It is the principle of subrogation which avoids this outcome, in that it allows the insurance company to take action against liable carriers in the name of the insured. The contingency or seller's interest insurance. The risk here is that loss or damage can occur and the buyer refuses to take up the goods or documents. It may even be that the buyer has not actually insured the goods. If the buyer attempts to avoid liability and legal action is often pointless, it can lead to a substantial loss to the exporters. Seller's interest insurance, sometimes called contingency insurance, covers the contingency that the buyer has failed to insure. Proximate cause. When a loss occurs, it is often the result of not one clear event, but of a series of events which cumulatively lead to a loss. What the insurers must do is to establish the actual cause of the loss, what they describe as the active efficient cause, that is, the approximate cause. As an example of this in action, consider a situation in which a road vehicle is in collision during transit. If goods are damaged in the collision, then there is a valid claim, as collisions is an obvious insured risk. However, if the goods are not damaged but the vehicle is, and this results in a delay of the journey for repairs, and your Christmas cards arrive at the wholesalers on Boxing Day, then there is no claim because delay is not an insured risk. Therefore, it is important to investigate the process of events leading to a loss and thus establish the proximate cause and then ensure that this is an insured risk.
You are insured for first, delay. If any loss occurs because of the late arrival of the goods, then there is no claim. It may be in this case that action is possible against the carrier. The transfer conventions defining what would be considered unreasonable delay in delivery, but not against the insurers. For example, you must provide a reimbursement to all expenses such as meals and transportation during the delay of delivery. Second, wear and tear. The exporter has to plan for predictable factors which could lead to loss, perhaps of value to the goods. So it means a damage that naturally and inevitably occurs, which usually stipulate that damage from wear and tear will not be covered. For example, the damage or error like components of an aging car parts of the body eventually wear out from repeated use. Third, inherent vice. This describes things which goods are apt to do and are therefore predictable. For example, it is obvious that metal has a tendency to rust, particularly in damp conditions, and the exporter must take steps to avoid such damage by priming or the use of silicone gels or shrink wrap, rather than rely on the insurance policy. Fourth, ullage. This is almost a form of inherent vice but specifically applied to liquids. So it means its purpose is to serve a left empty volume in a tank so that there is a space for a liquid in the tank to expand. Example, in a bottle of wine, there is an empty airspace at the top of a full bottle of wine. Last, willful misconduct of the assured. This may be obvious but extremely important in that the documentation supporting claims must prove that the claimant has acted prudently and that the loss is not the consequences of their direct action or negligence. So it means intentional disregard of good and product standards of performance. Example, person who knows that he is committing and intends to commit a breach of duty.
Claims document. Assuming the claims is actually being made for the consequences of an insured risk. The second reason that claims may fail is that they are not correctly documented. The insurance companies do not relevant to the claim. The documents typically requested would include original policy or certificate bearing. In mind that the policy is proof of interest, for example, insurable interest. This is essential. It also describes the subject matter, insured value, and appropriate clauses. Invoices and packaging specifications needed to assist the percentage of a part lost, especially where lost or damaged goods were packed. For example, where or when will you get your order? Original bill of lading or other transport document. Original bill of lading or other transport document proves the goods were in apparent good order and condition when shipped and evidences the contract or carriage should action be later taken against the carrier. Survey report or other evidence of loss or damage. An independent report of the nature and extent of the loss should ideally be produced by an approved agency, for example, Lloyd's agent. landing account, or weight notes at destination. The carriers or stowage brokers record of the outturn of the goods at destination, useful for identifying where damage took place in the container or on the vessel of haulage unit. Any correspondence with the carrier, other parties. Obviously, the insurers wish to maintain any legal rights against other parties and insist that the insured do not give them away.